The live intraday price for Invivyd Inc. IVVD stands at $2.65 per share, reflecting an absolutely explosive intraday gain of approximately 49.8% as of the moment we speak, making it one of the most volatile and top-moving stocks on the NASDAQ this Friday afternoon. Now, the common expectation here is simple. A microcap biotech stock soaring nearly 50% in a single day must be a textbook case of retail frenzy or a fleeting pump, especially when the broader tech-heavy NASDAQ has been showing signs of weakness recently. But the true insight that is driving this is far more substantive than just market noise. The massive surge in price and the staggering trading volume, which is already tens of millions of shares above its typical average, is being fueled by a key confluence of surprisingly strong Q3 financial results that just came out, alongside an extremely positive and strategically significant development concerning their lead drug candidate. Specifically, the market is finally and aggressively pricing in the implications of the company's Q3 revenue growth, which significantly exceeded expectations, and, even more critically, receiving FDA alignment on the development pathway for VYD3111, their monoclonal antibody candidate designed for the prevention of COVID-19 in immunocompromised individuals. This is not just a beat on earnings. This is regulatory de-risking being injected directly into the share price, a factor that fundamentally shifts the expectation versus reality equation for a pre-commercial stage biopharma company. For many, Invivyd was simply seen as one of the many post-pandemic companies struggling to find a sustainable footing after the initial fervor faded, a narrative that suggested a long, slow grind upwards, if at all, to achieve meaningful valuation. Today's reality, however, points to a potentially fast-tracked, high-impact product that addresses a persistent and often overlooked medical need, challenging the narrative that this company was doomed to perpetual cash burn and dilution. The immediate stock movement is a clear reaction to the positive business momentum, creating a tension where the expectation of a continued biotech slump has been decisively shattered. We're seeing a flood of fresh capital, indicated not only by the price jump, but also by the sheer force of the volume. This isn't just retail investors chasing momentum. The volume profile suggests significant institutional buying activity in the early hours of the session, attempting to catch up to the news. The sheer velocity of the move, hitting a new 52-week high, breaks out of a long-term trading range that had capped the stock below $2 for months, a pattern often seen in companies like Tesla stock when they break key psychological resistance levels on the back of major news. The trading floor buzz would be all about the analyst community, with reports confirming that at least one major firm has doubled its price target to $10, citing strong gross margins on the commercialized product, Pemgarda, and the newly clarified regulatory path for VYD3111. This sudden authoritative endorsement provides a much-needed signal to institutions and larger individual brokerage accounts that the underlying fundamentals have shifted, justifying a substantial repricing. While the stock has been highly volatile over the past year, trading as low as 35 cents, the current rally solidifies a major bottom and establishes a new floor, provided the regulatory and clinical timelines hold up. For investors utilizing platforms like Schwab Intelligent Portfolios or those pursuing self-investing strategies, this type of parabolic move in a small-cap biotech is a strong reminder of the binary nature of the sector. Massive reward on positive clinical regulatory news, or massive downside on failure. The key here is that the upside is now dominating the short-term sentiment. Looking deeper into the company's operational reality, Invivyd is a clinical stage biopharmaceutical company focused on the discovery, development, and commercialization of antibody-based solutions for serious viral infectious diseases, beginning with SARS-CoV-2. Their proprietary Invivyd platform is the core of their business model, essentially a sophisticated approach that combines viral surveillance, predictive modeling, and advanced antibody engineering to rapidly design new monoclonal antibodies, or MABs, capable of tackling evolving viral strains. This is a critical point. Their strategy isn't to develop one fixed product, but to establish a perpetual capability to generate next-generation antibody candidates, much like a tech company like Invivyd stock continually iterating on its chips, but in the biotech sphere. Their current commercialized product, Pemgarda, is authorized for emergency use for pre-exposure prophylaxis of COVID-19 in certain high-risk immunocompromised patients. The expectation was that Pemgarda's commercial success would be modest, given the shifting public health landscape and the availability of vaccines and oral antivirals. The reality, as evidenced by the Q3 report, is a 41% year-over-year growth in net product revenue for Pemgarda, suggesting a more robust market acceptance and execution than anticipated, particularly in the niche but critical immunocompromised population. This is where the tension is most apparent. A product widely dismissed as marginal is quietly generating meaningful revenue, providing a much-needed financial buffer to fund the pipeline. This success is giving the company crucial runway, supported further by a recent public offering that secured $57.5 million, aimed squarely at funding the VYD 3111 trials. For those engaged in online investing, tracking cash runway is vital for clinical stage companies. And this recent financing, coupled with the positive revenue growth, pushes out the less than 1 year of cash runway risk that analysts often flagged, alleviating a major overhang on the Tesla stock-like volatility they've experienced. The future outlook for Invivyd hinges almost entirely on VYD 3111. The expectation is that developing a new COVID-19 preventative treatment is a crowded field, potentially leading to low uptake and a slow approval process. But the reality is that the FDA alignment mentioned in the news is a massive accelerator. VYD 3111 is a next-generation antibody designed for improved potency and, importantly, an easier administration profile, specifically an intramuscular injection. This is intended to be a vaccine alternative for populations who either don't respond well to traditional vaccines, the immunocompromised, which includes transplant recipients and patients with hematological malignancies, or who cannot tolerate them. This group is a distinct and medically underserved market. The regulatory clarity means the path to a biologics license application, or BLA, the official pathway for full approval, is now much more defined and potentially shorter. The expectation was that the company would need to spend years navigating a complex regulatory maze, leading to significant delays and continued shareholder dilution. The reality is that the market now believes a pivotal trial can be initiated by the end of 2025, which, if successful, puts them on a relatively fast track towards commercialization in a high-value niche. This is the kind of specific, actionable catalyst that makes a stock transition from a speculative biotech to a clinical stage growth play, a distinction that platforms like Fidelity Investments, and their research tools will highlight for investors considering adding to their individual brokerage accounts. The institutional ownership structure, which already includes significant players like Vanguard Group and Millennium Management, saw mixed activity in the last reporting period, with some reducing positions, while others like Vanguard increased theirs by nearly 50%. This divergence confirms the internal debate among large investors. Is the risk of clinical failure worth the massive potential reward of a successful antibody platform? The current stock price action suggests the reward camp is winning the day. The risks remain significant, as they always do in the biotech space. Any setback in the VYD 3111 pivotal trial, whether it's an unexpected safety signal or a failure to meet primary endpoints, will instantly reverse today's gains and send the stock plunging. Furthermore, the company faces competitive pressure from other antibody developers and the continued evolution of the SARS-CoV-2 virus, which necessitates a constant need for new antibody iterations. This is the continuous development cost burden that keeps cash burn high. However, the Invivyd platform is explicitly designed to counter viral escape by leveraging sophisticated modeling, a key differentiator the company hopes will sustain a moat around its business. The current valuation, even after today's incredible run, is still considered highly attractive by the analysts who just upgraded it, suggesting a major disconnect between the company's potential, reality, and its historical trading range, expectation. The market is now being forced to confront the fact that Invivyd is no longer just a flash-in-the-pan pandemic stock, but a platform company with a validated commercialized product and a highly advanced candidate addressing a critical unmet medical need. The current technical breakout from the long base of consolidation is highly compelling, suggesting that momentum could carry this stock much further, possibly testing the upgraded price targets. For those who manage their own capital using tools like Robinhood, SoFi Invest, or interactive brokers trading platforms, the question is how much conviction you have in the VYD 3111 data and the company's ability to execute on the commercial ramp-up of PEMGARDA. Comment below how many shares of Invivyd Inc. you currently hold or what your target price for IVVD is if the VYD 3111 trial proves successful, and how that compares to your initial expectations for this stock. In summary, the expectation of Invivyd Inc. being a perpetually undervalued, high-risk, cash-burning biotech stock has been